Good afternoon, everybody, and welcome to Churchill Tax Advisors Tax Investigation webinar for this month. And we've got myself, Dave Jennings, and my colleague Dane Skeeber here today to talk to you about some recent tax cases. We like to throw in the occasional technical webinar with an update of cases that have been decided in the tax tribunals or other relevant courts that affect tax work, or in particular investigations, inquiry type of work, and that's what we're going to do today. We're going to cover 5 recent cases with some interesting points for everybody to take on board. As a brief introduction, I'm an ex-Inland Revenue HMRC Inspector of Taxes, spending nearly 20 years in HMRC, the last 15 years with various firms of accountants and specialists in the tax investigation sector and field. So 30 odd years experience on both sides of the fence. I use that experience and knowledge to help clients make disclosures or deal with investigations and inquiries right up to the tax tribunals. And in the past, I've provided expert witness on criminal tax evasion cases as well. And my colleague here, Dane, has a similar background.
Yeah, hi everybody. Similar to Dave, but slightly less long in the tooth. I joined HMRC in 2012. So after it was Inland Revenue, did my full inspector training there and left towards the end of 2018. Worked at Grant Thornton and then recently joined Churchill's a couple of months ago.
Brilliant, thank you. Without further ado, I will start the slides. If anybody has any questions, please leave them to the end. You can type in the box your questions. This is also being recorded, so you can catch up later and watch the recording. Or if you're watching the recording now, hello and welcome to the recording. So this is us. Churchill Tax Advisors provide a full range of tax and accounting services. We do provide specialist advisory and investigation services to other accountants, solicitors, IFAs, and the like, as well as direct to clients. So as I mentioned earlier on, we're covering some tax cases today that have been heard in either the tax tribunals or the relevant courts. And we're going to cover these topics. Burden of proof cuts across a number of the cases we're looking at today. And we're also considering discovery assessment appeals, deliberate penalties, and an important one, which is not wholly tax related, but it does involve a tax problem, and that is director disqualification. So the first case around burden of proof, and in this case, the position was it is a useful case because it confirms potential discrepancy that has occurred in some previous tribunals about which party has the burden of proof in information notice appeals. Information notices is where the Revenue have issued a formal request for documents and information relevant to the inquiry investigation that they're undertaking. There are generally 2 major forms of information notices: first party notices to the taxpayer, third party notices to somebody maybe connected to the taxpayer or who has information that may be relevant to the first party taxpayer. In this case, the Revenue issued information notices to pension scheme administrators on the basis that those scheme administrators would have had a potential tax liability themselves, tax responsibility for that scheme. This involved some tax planning arrangements for pension schemes involving 21 different people. They were all joined together as involved in a similar scenario. The appeal against HMRC's request for the information was on the grounds that it was not reasonably required of those administrators, and that the Revenue maybe should have issued third-party notices to the administrators, or they should have issued first-party notices to the underlying companies or individuals involved with the pension payments. The point of this case is where does the burden of proof sit? And it was held that ultimately the burden of proof sits on the appellant. Once HMRC have extinguished what's known as the prima facie argument that they have a reasonable requirement to request the information. So in this scenario, it was held that the revenue could prove that they did need the information from those pension scheme providers, administrators. They had already issued a notice to one of the pension companies involved. I think it was Dunbar Liddell, a national sort of firm of pension schemes, and they didn't get the information they needed from that, so they had to approach the individual administrators. So they were able to confirm the reason why they required the information. It then switched to the appellants, and the appellants then had to prove that it wasn't reasonably required, and they failed to do so. The information was still required. There was a slight amendment to some of the information, but the revenue were able to prove that it was required. So the initial burden of proof is on HMRC to say, to be able to confirm that the information is reasonably required. It then switches in the same tribunal to the appellant to then say, no, it's not reasonably required. In this case, it failed, and the information was reasonably required. The appellants couldn't extinguish that requirement, albeit there had been the tribunal did slightly amend the information that was needed by HMRC in this case.
Yeah, the second case we're going to talk about, this is one where the background to this is two brothers that had sold the property in 2017-18 tax year, hadn't reported anything to HMRC, but HMRC obtained information of this disposal, and that could be via a number of avenues, via sharing information with Land Registry or via the Stamps Department at HMRC. So then opened an inquiry into 2017-18. They asked for information to try and understand whether a gain should have been reported, but at the same time, suspicious of some rental emissions as well, extended that Schedule 36 notice to cover years from 2012-13 right through to 2017-18. The taxpayers were given more time to respond, given the amount of information requested. They failed to respond within time, and then they were hit with some penalties for failure to comply with those notices. The appeal was based on two things. Firstly, insufficient time, even though they were given an extension. Secondly, that the request was excessive, and that kind of relates to those earlier years being included within the information notice. Again, the first tier tribunal found that the burden is with HMRC to prove why the information is reasonably required. It's a well-established principle that, including what they say, going on a fishing expedition, just including a vast amount of information requests covering a lot of years without any real coherent reason why, specific to a risk that they're trying to address, isn't an allowable exercise from HMRC. So the records that they were requesting and what they were really entitled to request were those statutory records that would evidence the correct capital gains position and also the income tax position. So for capital gains, that would be things like the purchase and disposal price and any allowable expenditure throughout that period. For rental, similar, it would be any income rent receipts and any allowable expenditure. In this one, they would be allowed to request personal bank statements, but only if the personal bank accounts were those used to either receive rent or incur expenditure. But again, it kind of covered some of those years that were out of time. So I think they struck off the 2012-13 year was found to be excessive. It was outside of the 6-year time limit for their non-discovery assessment provisions where careless behaviour had been shown. So to ask for anything more than that, you need to have evidenced deliberate behaviour. There were some other comments coming out of this one regarding legal professional privilege, that the details of the solicitor used for the disposal, there was correspondence with that solicitor, but they didn't have to share those details, and you don't have to share those details unless there's evidence of fraud or dishonesty on the solicitor's part. I think the end result was the first tier tribunal set aside or varied some of the information notices, either those that were out of time or where they were found to be excessive, but the penalty was upheld and the appeal was dismissed, given that they did have sufficient time to provide a response that they failed to do.
Yeah, good. Thank you, Dane. And again, it confirmed that the initial burden of proof is on HMRC to say that the information is reasonably required, and they were able to prove that it was, because they had information about the sale of the property, and they had information that rents had never been disclosed. So that was the revenue got past their burden of proof very quickly on that case. The next one we're going to cover is a case that many people have been following for many years, and this is regarding Mr. Raymond Tooth. This case has gone through the first tier, the upper tier, the Court of Appeal, and now the Supreme Court. So it is definitive on these issues. There was two sides to this case. One was around whether or not the client had their behaviour was deemed to be deliberate. The other ground was on whether or not the Revenue's discovery assessments had become stale, in that they'd issued the assessments too late. So the background to the case was that Mr. Tooth had been involved in a tax saving scheme arrangement with losses. When he completed his tax return, the software wouldn't allow the information to go in the boxes that it should have gone in. So he entered all the information, his accountant entered all the information in a different box. All the information was still provided. It was in white space entries, or it was in the wrong box. But HMRC were told on the return that this had been put in the wrong box because it wasn't possible to put it in the right box. The Revenue opened a Schedule 1A investigation into the return, which is an investigation into a claim, which was a claim for the losses. That was the wrong form of inquiry, so they should have used Section 9A inquiry notice. So therefore, they were out of time for the inquiry. And as time moved on, therefore, their only way of trying to recover the liability was to issue an extended time limit assessment, discovery assessment. This was over 6 years old at the time they issued the assessment, and therefore it was out of time under the normal rules of maybe careless behaviour. They would have to prove that the taxpayer had acted deliberately. So the Revenue had said that Mr. Tooth had deliberately put the wrong information on his tax return. When looking back in hindsight, you think that's quite a surprising move by HMRC, because if he'd given all the information on the tax return, he'd just used the wrong boxes. How could he be deliberately trying to not pay his tax? He'd declared the information that was necessary. And ultimately, on that point, the Supreme Court decided that the return had not been misleading at all. Mr. Tooth had not acted deliberately to evade his taxes or confuse HMRC or not declare his taxes. So the extended time limits rule failed on that point, and therefore the discovery assessments were invalid. The Revenue couldn't prove that he'd acted deliberately. However, the other appeal point, which had been running for all these years through the different tribunals and the Court of Appeal, which was probably of greater interest to most advisors, was the concept of staleness. That came about on the grounds that it's been argued HMRC, when they have sufficient information, should issue the assessments in good time. There have been a number of cases that have gone through the tribunals, many of which have then been dependent on this decision, have been stayed or have moved up the tribunals, waiting for this final decision of the Supreme Court on the issue of staleness. There had been a sort of rule of thumb that if HMRC issue an assessment within 3 years of knowing about the understatement of tax, knowing about the discovery, then that was probably okay. Beyond 3 years of knowing about the information was maybe deemed to have been stale. If the Revenue sat on it for a long time and then issued the assessment, the appeal grounds were that the Revenue's assessments had become stale and they should have made more tedious use of that information and assessed quicker. The Supreme Court in Tooth, although they didn't really need to make a decision on staleness because this case already fell out on the deliberate rules that had not been misleading and therefore the revenue were out of time anyway, did issue a decision on the staleness point. And they said there is no concept of staleness within HMRC's inquiry or investigation process or time limits. And therefore, in effect, HMRC could have up to 20 years to sit on the information before issuing a discovery assessment, providing obviously all of the points such as the behaviours fit in with the time limit standards. So what is very disappointing for many advisors and appellants is that there is now no grounds for appeal on the issue of staleness, that if the revenue have sat on information for too long, they can't issue the assessment. They can. Now, whether any other cases will be determined on individual facts remains to be seen. But basically, Supreme Court sets some precedent, and we don't really have any grounds, I believe, to go to the European Court anymore. Now that it's post-Brexit, so this case will stand. And staleness is a concept that has now disappeared in tax appeals.
Thanks, Dave. Another one here where we're looking at deliberate behaviour and where the burden lies there. This one involved an individual that was employed by Morgan Stanley and was made redundant in July 2016. After his employment had ended, he actually received a further payment of about 176,000, I think. And then there was also a loan that he'd received the year before that was written off for 143,000. The taxpayer in this instance failed to include both of those in his 2016-17 return, and HMRC then went on and issued a deliberate penalty. HMRC's grounds for issuing that penalty is because his affairs were quite straightforward and he didn't take advice when completing his tax return. Again, the burden on this one falls on HMRC to show the taxpayer knowingly submitted an inaccurate document, knowingly omitted something from the return. The first tier tribunal found that the taxpayer in this one had believed he'd filed an accurate return on the basis that he'd used the figures from his P60 and P45 to complete that. They also found the taxpayer didn't understand the treatment of the loan waiver and wasn't aware that it wasn't needed to be included within the return, and also that he wasn't aware that his return was inaccurate until he was told by HMRC. So again, the burden falls on HMRC to show that there's been some element of deliberate behaviour here. HMRC, what we see quite a lot of now is HMRC's initial approach when considering penalties is to start at deliberate without necessarily the evidence to support it. But this is a case that shows that actually it is a serious allegation, and as such, the burden is on HMRC to kind of provide that evidence, to provide that backing to show how they've arrived at that decision. Saying that somebody's tax affairs are straightforward isn't enough on its own, and they need to take another step. The interesting point with this case as well is HMRC probably, if they put forward an alternative case of carelessness, it's expected that they would have received at least some penalty for that position. Whether or not that could have been suspended is a separate matter, but HMRC only proceeded with this one on the basis it's either deliberate or there's no further argument if not. So there was no penalty, and the taxpayer didn't have anything to pay there. I think you're on mute, Dave.
As a cliche, you're on mute. It's a strange case, Dane, isn't it, where the revenue have gone for all or nothing without a fallback position. I've never seen the revenue say that if it's not deliberate, then there's no penalty at all. They'll say it's a mistake. It's quite odd. You'd think that if you'd not been deliberate, then you'd maybe been careless. Yeah,
it's certainly a strange one that it didn't feel like it had to be an all or nothing for them to get something from it. But there you go.
And because he'd made a similar mistake in the year before, then you would, and that was the grounds in the revenue trying to say you've been deliberate because you'd also made a mistake in your earlier year's tax return. You would therefore think, bang to rights maybe on careless, that you've done it 2 years running. yeah, I mean, I think that it was a right decision because at worst, the taxpayer had been careless. I think to say that they'd deliberately not included some of the income from their employer to defraud HMRC was, I think, certainly not in their intention. And maybe the Revenue should have pursued a careless case in the first place. So the Tribunal, I think, made the right decision on the behaviour. Again, the burden of proof fell with the Revenue to prove they were deliberate, and they failed. Our final case today isn't a tax case, but does involve tax. And the involvement of tax in this scenario was that a company had entered into an employer-funded retirement benefit contribution scheme with EDF. The company had various trading and commercial issues that resulted in it ceasing to trade. That was after it entered into these tax arrangements. But after ceasing to trade and before entering liquidation, there was the funds had been transferred from the company to the directors by way of correcting their loan accounts for them to withdraw the cash from the company. The directors claimed that they were owed these funds for the past from the company with monies put in. But at that time, it was held. HMRC were pursuing the tax scheme. They'd issued regators. They were looking to take a case through to tribunal, and there was documents and information that suggested the directors had known there was a risk that the scheme may fail and liabilities would be due to HMRC. The directors didn't try to deny that in this hearing, and made various other allegations as well, all of which the judge dismissed. And ultimately, it was decided that the directors knew there was a contingent liability. So even though the scheme had not been proved to have failed at that particular point, the directors had failed in the standards of care of their duty to the company in taking money out of that company, reducing the assets of that company, and therefore the company would not have the funds to pay HMRC. HMRC being a major creditor on liquidation, and therefore it was held that the directors had failed in their duties to ensure funds were kept in the company, knowing that there was a risk to the creditors. They shouldn't have taken those funds out. So once it was found by the judge that the directors at their standards was less than it should be for a director, there is a mandatory disqualification. So even though here there's maybe no actual tax liability at that point, the directors have been disqualified. So directors can be pursued for other reasons, not just tax, if companies fail. And we are seeing more and more director disqualifications being brought, maybe referrals from HMRC to the Secretary of State, or brought in direct from insolvent practitioners, for instance, who are acting for the company. They have to look at misfeasance or preference or other issues that directors have maybe undertaken. I think many business owners sometimes forget that they are not sole traders. The company is a different entity, and the director has a requirement to the shareholders, even if that shareholder is himself. There is still the whole point of limited liability is there is a corporate veil between the company and the director has responsibilities for that company, and if they fail, it can be disqualified. So a salutary point there, that even if a tax scheme hasn't been proved to have failed, if you take actions without professional advice, then you could fall foul of other laws other than the tax law rules. So today there's been a bit of a theme through some of these cases of burden of proof. Where does it fall? Is it with the appellant, taxpayer? Is it with HMRC? At which point do they have to prove their case? In Tooth, we found out that staleness is not a concept in inquiries. It can't be used in appeals, and we also need to watch out that even if a tax liability is contingent, if a company takes certain actions or directors take funds out of a company in preference, there is a risk of disqualification. So here are my contact details. It's d.jennings@churchill-tax-advisors.co.uk. Please contact me if you need any more information or you have any questions from today's sessions. My colleague Dane is d.skiba@churchill-tax-advisors.co.uk, or give the office a call if you want to speak to either of us. You've got some questions about investigations or tax issues. It's 0207 998 1834 if you want to approach the firm. We run these events once a month on investigations, alternatively with our tax planning colleagues. Jamal Khan and Alan Milne usually present at the tax advisory seminars. Please do watch out for those as well. If you watch the recordings of these webinars, look them up on YouTube. They're available there, or our website. Keep an eye if you get an email reminder. And we look forward to meeting you next month with another topical webinar around tax investigations. Thank you for watching. Thank you for attending. Thank you. Goodbye.
Cheers.